Welcome to another episode of Purchase to Profits. I'm Seth Ferguson. Make sure you hit the subscribe button so you don't miss our daily interviews with successful real estate investors. Our guest today was the fifth guest we ever had on the show, and I'm thrilled to have him back. Since founding his company in 2004, he's helped thousands of real estate investors create wealth and passive income. Marco Santarelli is the founder of Norada Real Estate Investments. Marco, welcome back to Purchase to Profits. It's great to have you on the show.
Seth, it's great to be back. I'm very happy that we're recording this today because I'm excited about our topic.
Yeah, we have a really interesting topic. You've got 10 rules to live by in real estate. So this is going to be a little bit different because we already heard about your Keystone deal on the first episode that we had you on. So tell us about your 10 rules.
Sure. So I've been investing since I was 18. That's when I bought my first rental property, and that was many, many years ago. Back in 2003, I started investing in real estate again full time. And so in the process of doing that, I tripped and fell and made my fair share of mistakes and lost money along the way. And part of the reason is because I was investing from 3,000 miles away. I live here in Southern California. And as you know, I'm a native Canadian. But now I have multiple citizenships, so I live wherever I want. But from Southern California, I'm investing 3,000 miles away in other markets, from Florida to Georgia to Michigan. And so in the process of doing that, I learned a lot, but at the same time, I also made my fair share of mistakes. And so over time, I created essentially what are over 10 rules, but I like to call them the 10 rules of successful real estate investing. And really, they're just things that are so fundamental, like they're the fundamentals of the fundamentals that you should have as a real estate investor and you should follow, so that way you don't make the same mistakes, and that way you stay focused on what you should be focused on to assure that you'll achieve a certain level of success. So what I would like to propose is that we just go through these one at a time. I'll tell you a little bit about it, and then if you have any comments or questions about each and every one or any of them, we can have some dialogue about it. So having said that, let's just kind of get into the very first one. So the first one is going to come as a of course, that makes sense. Why wouldn't it be, right? But the first rule is really just educate yourself. If you're going to be an investor, you should start by investing in yourself. Invest in yourself first, because if you do that, then you will be more knowledgeable. See, knowledge, I like to call knowledge is the new currency. It is something that is measurable, it is valuable, and it's spendable. And if you apply it, if you put action or execution behind that knowledge, it's amazing what you can accomplish. So if you don't have knowledge, the problem is you become doomed. You're doomed to follow other people's advice. And the thing is you don't know if that advice that people are giving you is good or bad. Why? Because you're ignorant to it. And that's not a bad thing. It's just you don't know what you don't know. But there's also those things you know that they're out there, but you don't know about them, and you could easily educate yourself. Like if I want to be a real estate investor, and I know it exists, it's out there, and the information's out there, but I don't choose to follow, a path of educating myself on it. Well, then I'm still ignorant. I still don't know what I don't know what I know is out there. So knowledge will take you from being a quote unquote good investor to becoming a great investor. And that's the key. And also that, that knowledge, when you apply it, helps to create passive streams of income. And that's really what we want, because if you have passive income for you and your family, you've essentially created financial independence and then ultimately financial freedom. And now you can do what you want, when you want, on your own terms. But it all starts with an investment in yourself and building your level of knowledge.
Yeah, no, 100%. And the one thing I've discovered in working with different investors over the years is that the level of knowledge you need to increase to go from good to great isn't that much. To separate yourself from the pack, it's just specializing a little bit more. Understanding the nuances a little bit more, if that makes sense.
Yeah, you're absolutely right. There's a compounding effect too, because if you decide, okay, this year I'm going to read 2 books or 5 books or 20 books, you've created a web of knowledge in your mind. And then what happens is as you start to read more, you start to add to that web, and it starts to grow exponentially. So your knowledge and information stacks and connects to what you've built before, and then that grows like a mushroom. So you have this compounding effect.
Mm-hmm.
So yeah, I mean, there's you cannot understate the importance of having sound knowledge. And then the important thing is to add experience to that. So to take that knowledge and put it to use. That's called execution.
Yeah.
So leading from there, you kind of go to the next step, which is really just setting investment goals. And I know a lot of people hear this, but a lot of people don't, actually think about it, let alone write them down. So, people wish to have this and they wish to have that, but the problem is a goal is much different than a wish. You can wish to be rich, but that doesn't mean that you'll ever take steps to make that dream or that wish come true. And that's the difference between those who think about, set, and write goals versus those that just think about what they would like to have, right? So the key here is to set very clear and specific investment goals, and then to keep breaking that down into more specific bullet points that they actually become tasks. Because when you do that, you have a clear vision of what it's at the end of the horizon, your end point. That becomes your roadmap and then your action plan to become financially independent. So you can actually plan this and map this. And you're kind of smiling because I know you know what I'm talking about.
Yeah. Yeah, and it's interesting because yesterday I was listening to James Clear on the London Real podcast, and he studied how people set and work towards goals, and so he talks about just like you said, you have you have your goal, but then what really matters is the execution. So the tasks you're talking about, taking that goal, but turning that into actionable steps, and you create the habit in the system.
Yeah, I mean, it's been proven time and time again that you're statistically far more likely to achieve financial independence and financial freedom if you just write down specific, clear, and detailed goals. And, I mean, this has been proven decades ago, and they've actually followed people from early grade school through their life, and they found that those who wrote down what they wanted or what they wanted to achieve, more often than not, actually got there or came close. So, goals can include anything, like the number of properties you want to acquire each year, the annual cash flow you want to generate, the types of properties, the locations. You can set parameters on your rates of return. It could be anything. It could be, even material stuff like trips or your next new car or whatever it may be. But the question is when you map out how you're going to get there, then it becomes executable. In other words, you have an action plan that you can start moving forward on. So
yeah, and it also helps keep you focused where you're not distracted. So let's say I want to become a real estate investor and I want to own, let's say, single family homes. By having that goal, I won't be distracted by somebody coming at me with a mobile home park.
Right.
Like
shiny objects.
Yeah, so I'm focused on exactly, I know what I want. This is what I have to do. So I'm able to say no to the opportunities that I might be distracted by.
Right, exactly.
Yeah.
So the third and the fourth ones actually are related to each other. So the third one is don't be a speculator. Never speculate. You should always have a long-term perspective in mind when you're investing in real estate. I mean, that kind of goes without saying, but a lot of people didn't do this back in 2003, 2004, 2005. They thought they were investors and they were really just speculators looking for capital gains and appreciation, and they were chasing that. And unfortunately, many of them, to the tune of million plus people, got caught with their pants down because they realized that, okay, the market turned, they can't sell it. It's now worth less and less and less, and to the point where it was worth less than what their debt was on the property, and now they're upside down and they had to walk away from the property. This happened literally to tens of thousands of people, and the numbers I've seen is it affected millions. But you should never speculate on quick short-term gains and appreciation, even in a heated market like you've seen in Toronto, Vancouver, San Francisco, Southern California, many places around the country. If that's your only reason to be, quote unquote, investing in property, then you're really a gambler. You're speculating. Yeah. So you never know when a market will peak, and it takes about 6 to 9 months after that market peak to actually realize, to measurably and quantifiably know that you've reached the top and the market is now contracting, or rates are compressing. And so you don't want to be caught in that game. So don't chase after appreciation. It's really when you invest prudently and invest in value plays where the numbers make sense from the day you buy the property that you actually are truly investing. And that segues to number 4, which is invest for cash flow. You see, with very few rare exceptions, you should always buy investment property that has positive cash flow, true net numbers after all expenses, including vacancy and your maintenance and repairs. The higher the number, the better, but you don't want to sacrifice being in lower grade neighborhoods, questionable areas, just to make up for that cash flow or those rates of returns. So what you want to look at, assuming you're in a good market, is the cash on cash return. That's directly related to your before tax cash flow. And then you can project out what your cash flows and rates of return will be over the next, 2 to 5 years, and then longer term, 10 and beyond. But I always like to say that cash flow is the glue that keeps your deal together. And the reason I say that is because if your tenant is paying you rent every month, and you're able to cover all your expenses and your debt service, and you comfortably have a net cash flow after all that, well, that is positive spendable cash that you can take to the bank or reinvest. But the fact that your tenant is paying for all your expenses and your debt service, that keeps your deal alive. That means that every month and every year that property's there and it's gaining in equity because of amortization, it's gaining in equity because of appreciation over time. So you grow in your net worth, your cash flow will also increase in time. So it's that cash flow that keeps your deal together. It's the glue. So any questions about that or any comments?
I was just going to say that positive cash flow helps you acquire the second property and the third property because it starts to snowball after a while.
It totally does. Yeah, it does. And you don't see that in the first year or two. But as you start to build your portfolio and after 3 to 5 years, you start to realize the power of what you're doing. And then you can start to compound your growth or accelerate the pay down of your mortgages on your existing portfolio, which when you knock them down one at a time, you start to increase your overall net cash flow every month. And so you become more and more cash flow positive. You become more financially independent. And so, yes, there is a snowball effect with that.
Yeah.
So investing for cash flow is critically important.
Yeah. And with your own portfolio, because we had mentioned, the heated markets of, Southern California, Toronto, New York. For yourself as an investor, do you shy away from those markets and focus more on cash flow markets?
Yes, absolutely. So yeah, I'm in a bubble market here. It's a very expensive, overpriced market. We have a lack of supply, which is helping to keep those property values up. But you can make similar arguments about the markets for the greater Toronto area, the Vancouver area. Like so many of these markets are very expensive. But as an investor, the numbers don't make sense there, because if you're buying these properties that are, let's say, $1 million plus for a single family home, but it only rents for what I call a rent to value ratio. In a market like Toronto, you're probably looking at 0.4% of that property value. That's typically what you're going to get in monthly rent. Well, at best, you're going to break even. When you truly run your numbers correctly, you're looking at true net numbers in terms of cash flow. That doesn't work. That doesn't work in any market, because what you want to do is you want to be close to 1%. It could be a little lower. It's nice if it's a little higher. You don't want to sacrifice markets or neighborhoods for doing that. But yeah, I can't find a good deal in my backyard here in Southern California. You'd have to find something that is very undervalued, meaning you're buying it at a very big discount, and odds are it's going to be distressed, meaning it needs work, so it needs to be fixed up. And that's okay if that's what you do. But I don't want to be doing that active approach. I don't want to be a market or a property rehabber and a property flipper. I want to be a passive investor. And that's what I talk about on my podcast. That's what we talk about to our clients. That's what we help people do, is build a large real estate portfolio to create their financial freedom and do it passively, meaning it's a more or less done for you solution. So my focus is on cash flow. My focus is on healthy markets that provide that for me, which is a perfect segue to, my fifth rule, and that is being market agnostic. I mean, this is what we're talking about without actually saying it. So, you take a country like the United States, and you can apply this to Canada as well, but the United States is a very, very large country. It's made up of hundreds of metropolitan statistical areas, MSAs. And the same thing is true for Canada, although we probably have more markets overall in an aggregate total here in the US. But the rule applies. And so when you look at markets as being local real estate markets, they all run independently of each other, then you start to realize that there's no such thing as a housing market. There's no such thing as a national housing market. Every market is local. Every market stands on its own. Every market moves up and down independently of one another due to many local factors. There are a few macroeconomic factors, but for the most part, markets move independently. And we talk to our clients about this all the time because they need to realize that you need to start by choosing a market, which we'll talk about in a minute because that's the sixth rule. But when you recognize that there are times when it makes sense to invest in a local market or a particular market, and then there are times when it does not, then you start to have a new perspective on investing in real estate. You see, you should only invest in markets when it makes sense to do so, not because not because you live there and not because you bought properties there. See, there is an element of timing when it comes to real estate, but I'm not suggesting that you be a market timer. There are ways to do that, but most people don't know how to do it and don't do it well. The better solution is not try buck the trend, but just be in a market that is strong, healthy, and ideally growing in terms of jobs, in terms of population. That's how you choose a market, ideally. And if you do that, then you've accomplished a lot towards lowering your risk and maximizing your return when it comes to a market.
Yeah. And I'm sure you'll agree when you're selecting markets to invest in, it's not like you just pull out a map and say, hey, this looks like a good market. You take a lot of time to look at, your GDP growth, job growth, population and migration, all those key market drivers that will really push that market going forward.
Yeah, you named it. I mean, there's just a lot of things there. Yeah, it's about productivity and growth and the diversity of the market and the level of jobs and the job growth and population growth. Is it net positive? What are the future prospects for that market? Is there a lack of supply or abundant supply? I mean, these are all things that we look at. That's why we've picked the 22 markets that we're in right now, and that expands and contracts depending on the teams we have on the ground and amounts of inventory, but you shouldn't let your eyes glaze over and worry about that kind of stuff because you can do your own research and figure this stuff out. But when we get calls from investors, whether from Canada or the US or the UK or wherever, we first find out about them, and then we start talking about markets as it relates to them and their investment goals and their risk tolerance and all that kind of stuff. Mm-hmm. So you really need to be market agnostic. It's just like, I think I said this to you on the last time we were on a podcast recording here. I think I used the analogy of investing in Coca-Cola stock.
Yeah.
I don't know did I?
Yeah.
Yeah. So if any of the listeners listening now don't remember that, it's basically this. If you do all your research and you determine that Coke is the best deal going, and if you're going to invest in a stock, Coke is it. But you happen to live in Toronto and not in Atlanta, Georgia, where Coca-Cola is headquartered. Would you not invest in Coca-Cola because you live in Toronto and it's not in your backyard in Atlanta, Georgia? Of course not. That's ridiculous. So that's being agnostic. You're not worried about where that company's headquartered. Same thing with property, because you're not managing your properties at the end of the day. You're going to have professional management do it.
Yeah. And I think that goes into, even if you're buying your first property, you have to start thinking about real estate as a business, right? We're talking about making prudent business decisions, not an emotional decision because I just want to be able to drive by my property every day and look at it.
Exactly. It is a business. You have to think of your efforts and what you're doing in real estate as being a business. So. Yeah. So that was 5, being market agnostic. So 6 is take a top-down approach. So this segues from number 5 in being market agnostic. What you should do, and what we always do, is we start with the market in mind, and then we start looking down towards the sub-markets within that major metropolitan area, because some are ideal for investing, and some are doing better than others. So if you narrow it down, then it makes it easier to be focused in the right areas. And really that you work your way down from, the market down to the neighborhood. This is not a hard thing to do. It just takes some time and some research if you're doing it on your own. If you're working with a team, that's no big deal. But the best approach, as always, is choose your city or town first based on the health of its housing market and its local economy, what we just talked about before, such as, the unemployment, the job growth, and population growth. And then from there, what you do is you narrow things down based on the best neighborhoods. And you look at things like the amenities, the schools, crimes, rental demand, the size of the rental pool. And then finally, you start looking at the deals themselves, the properties within those neighborhoods. And then, of course, wrapped around that is your team, because your team is what's going to help you become and stay successful. And one of your most important team players is your property management company. So think of it like a funnel. You start with the market, you work your way down to the properties and the teams, and that's really taking the top-down approach. And that's what I like to do, and that's what we work with our clients in doing.
Yeah, no, that's a good way to put it, the funnel. I like it.
So after you've done that, number 7 is diversify across markets. So the idea here is that you start to build a portfolio, and you should build a footprint in one market that you've identified as the best market for you to start with. And then what you do is you diversify geographically into another market that typically is in another state, or for you, another province, because it's going to have different dynamics and different local market drivers and its own local economy. But you focus on one market at a time. You accumulate, the rule of thumb, 3 to 5 income properties in that one market. And then once you've built that, then you move to market number 2 and you do the same thing. You build 3 to 5 properties in your portfolio in that market. And then you diversify into a third market that's geographically different. And typically you don't need more than 3, but 3 to 5 is a good number. I like to call it 3 to 5 in 3 to 5. So 3 to 5 properties in 3 to 5 markets. The underlying reason for diversifying within the asset class of real estate is really just to spread your rental portfolio across different economic sectors, because, Calgary is driven by oil and gas. Toronto, I'm not sure. Toronto's very, broad. So there's probably a lot of manufacturing and, hospitality and finance and that kind of stuff in your market. So you're really just helping to reduce your quote unquote risk, because what happens in one market probably won't be happening at the same time in another market. So, and this really has more to do with property values, not so much the cash flow, like the rent. The rents often don't fluctuate all that much. And sometimes in bad economic times, they actually go up because there's a diminished pool of rental property. More people leave their homes and choose to rent instead of buy because they either can't afford it or they can't qualify. So it actually works in your favor, interestingly enough. Any questions about that?
No, I think you brought up one of the most beautiful things about real estate, where you have, in tough times, people can't really, they're losing their jobs, they're turning to renting, they can't afford to purchase a home, so your rents get a boost. But then in the good times, your property value goes up as well.
Yeah, yep. You can weather economic cycles better when you diversify, and you can weather through local real estate cycles over time much better as well when you're diversified that way. Mm-hmm. So number 8 should go without saying, especially from the perspective where we come from in terms of passive real estate investing, but let's use professional property management. Now, if you've got properties in your backyard and you know what you're doing, you have experience, and you understand tenant landlord laws, and you're not going to stick your foot in your mouth or get yourself in trouble because of laws and the regulations and the fair housing laws and all that kind of stuff, I suggest you never manage your properties. There are exceptions to this, and people do it successfully, but as a general rule, use professional property management. So, I've always said that management is a thankless job. It's really a job, and you're to some degree you're creating your own business. But you need a solid understanding of the tenant landlord laws, marketing skills, strong people skills, knowing how to deal with tenants, how to deal with their complaints and excuses. But really the bottom line here is your time is very valuable. And if you want to be doing something that you're going to pay a property manager $100 a month to do, in terms of managing your property, then go for it. But really, I see my time as being more valuable than that. So I don't want to spend it managing properties and dealing with tenants. And even though it might be a minimal amount of time each and every month, I'd rather spend it on my family, my career, building this business, doing my podcast, looking for more property. That's where I want to spend my time.
Yeah, that goes. It was Michael Gerber's book, The E-Myth, about how you extract yourself from the day-to-day tasks and start building a business. Right, that's what it's all about. Yeah.
No, you're exactly right. I mean, that's a great book. I mean, it goes back many years ago. But yeah, there's people who think they know how to do the job well, and they're I forgot what he calls it. They're maybe you remember.
Oh,
The tech,
technicians. Technicians start. Yeah.
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 But the thing is there's probably someone who could do it better than you, more effectively, and you can apply your time better in more valuable, productive ways than doing the management yourself.
Yeah.
So number 9 would be maintaining control. The thing I like about investment real estate, particularly, what we focus on, which are single family homes and some duplexes and fourplexes peppered across 22 markets in the US, is maintaining control. See, when you invest in real estate, you are a direct owner. You may not own, you control everything, but the bottom line is you own it all. And when you do that, you call the shots. You're the CEO of your company. You set the direction of how you grow your portfolio and who does what and what monies you spend and how you collect the money and how you reinvest it. You don't leave it up to corporations and fund managers, because when you're investing outside of yourself, what's happening is you're essentially handing your money over to someone else, hopefully someone you trust, and hopefully somebody or a group of people that you know. But when you're invested in like funds and partnerships and other paper-based investments, not real assets, but paper-based investments, you're essentially owning shares or interests in other companies. It's securities. So you're essentially giving up most, if not all, of the control, because you don't have you can't give direction and you don't have voting rights. So if you're okay with that, that's fine. If you know the syndicators of a particular real estate deal, and I'm not talking about like a real estate investment trust, a REIT, because that's still a paper asset. It's publicly traded. I'm talking about an actual real estate deal where you have a small group of partners and you know and trust these people. That's okay, because you still have essentially direct ownership and direct control, but to a much limited degree, because partners are partners. It's a hard ship to sail, as they say.
Yeah.
So maintain control, and that's the beautiful thing about building your real estate portfolio. We're down to one more. Any comments so far?
No, hey, you're rolling. I won't stop you now.
Okay. Well, the last thing is one of the most beautiful things about investment real estate, and that's leverage. The fact is that lenders and banks are willing to lend you 70 to 80% of the purchase price of your real estate acquisitions. And that's a beautiful thing when it comes to real estate, because that helps to magnify your investment returns. See, real estate is really one of the few, if not the only, investments where you can borrow OPM, other people's money, and you can use that to purchase and control income-producing property. And that allows you to leverage your limited investment capital. If you can do that, then you can get further faster. See, leverage magnifies the overall rate of return on your investment, on your real estate investment specifically, but your investments in general. And in doing that, it helps to accelerate your wealth creation, because now you have equity growth across multiple properties and you have more cash flow, more passive income coming in than if you bought one property all cash or two properties all cash. Why not leverage that 4-to-1 or 5-to-1, as we can do here in the US with 80% financing, and have 5 times the size of your portfolio and have 5 times the growth potential, 5 times the equity growth. And it's not 5 times the cash flow because you have debt service, but it is certainly more than just buying all cash. So the bottom line to all this, when you kind of take these 10 rules and you crunch them all down, is if you're building a portfolio prudently and intelligently, and you have positive cash flow and you have tenants paying off your mortgage and it's growing at your equity and creating more wealth for you, you ultimately would be foolish not to borrow as much money as possible to buy more income property and grow your portfolio.
Yeah. And especially if you're holding your portfolio over an entire cycle, why wouldn't you want to have as many properties as possible, leverage as much as not to say you're going to leverage it up to the hilt, but an amount of leverage that makes sense.
Yeah, it's not a question about how much leverage you have or how much debt you have. This is good debt, not bad debt. We're talking about investment grade debt here. It's not a question about how much you have, but it's a question about how much can you get. Because think about it this way. If you want to be worth $5 million, you know what the best way to do that is?
Borrow $5 million?
You're right. Borrow $5 million against real estate, because that $5 million of debt is being paid off by your tenants. And over time, and you can control the length of time that it is amortized, But that 5 million in debt ultimately becomes 5 million of equity.
Mm-hmm.
And that's how you gain $5 million worth of equity, is you go into debt for $5 million.
Yeah.
So, so when you can get cheap debt on income producing assets, you should get as much of it as you possibly can, and do it in the markets that make sense, and have the right team to work with you and hold your hand to actually accomplish that, because it's easier and faster to do it with working with people who have done it and know what they're doing, than to try and learn it on your own. And a lot of investors are kind of blinded to the fact that they live in a market and that's all they know, and that's all they choose to look at. And there's this element of ignorance. They just don't look beyond their borders.
Mm-hmm.
But that's a mistake, because a lot of the so-called gurus, and I say gurus in quotes, a lot of the gurus tell you to invest within like a 1 or 2 hour radius of where you live. That's flawed thinking. That works if you're a rehabber or a flipper, because then you can, farm the areas, find the deals, fix them up, manage them, or be a general contractor on your own deal, and work the deal because you're local, even though you might not be doing all the work. But when it comes to investing in buy and hold cash flow real estate, where you're just building a passive portfolio of rental properties, then you're not tethered to your local market. They could literally be anywhere. It always comes down to just having the right team. So don't fall into that trap of thinking that if I live in Toronto, I have to invest in Toronto, because number one, it's going to be very difficult, if not impossible. And second, you're really limiting and constraining your growth and your success.
Yeah. So if somebody's starting to build their team, what sort of people should they be approaching? What sort of questions should they be asking?
The types of people you need on your team, is that what you're asking?
Yeah.
Well, first and foremost, you need your acquisitions person or people. And that could be real estate agents, real estate brokers. They could be wholesalers. They could be sometimes property managers that just know of clients that are looking to sell their property. It could be a turnkey provider / promoter, like our company, Norada Real Estate, because that's what we do, is we provide investors with turnkey, investment grade rental properties. Who else would there be?
Well, you've got your accountants and all that stuff too.
Well, yeah, I'm getting to that, but person number one, kind of the first person in that food chain is your deal source, your acquisitions person. So that's why I'm saying it's a real estate agent, or a wholesaler, or somebody that can find and bring you the deals.
Mm-hmm.
Okay. So once you have the deals, now you need to have an attorney or a title company, depending on the state or province you're in, but someone who's going to handle your legal work and your closings, the escrow work. You're going to need a tax advisor that may not be a CPA, but it's some sort of, certified person. But the most important thing is they need to understand the tax laws and how they can minimize or reduce or eliminate taxes for you, not just a form filler person and a paper pusher. You'll want a professional full-service property management company in each of the markets where you have property. That is a key position. That is one of the most important people on your team. Property inspector, in the markets where you're acquiring properties, you want, property inspection. An asset protection attorney, someone who can put together your LPs, LLCs, whatever the structure is that makes sense for you from an asset protection perspective. Maybe someone that will help you with your wills, trusts, and creating, preserving your wealth for generations to come. So these are the people on your team. And so you can find them and vet them. Of course, there's many of them out there. Many are good. Most of them are bad, in my opinion, but a lot of them are good. Some of them are great. And so, we've vetted a lot of these people. We're happy to share them. But that's your team, those 7, 8 different types of people.
Yeah. And if somebody's out there looking for a turnkey provider, what sort of questions should they be asking?
Well, first and foremost is reputation. And that's not necessarily a question. That could be research that you do on your own. Reputation's huge. How long have you been in business is not a big factor, but it's a question. What services do you provide? What services do you not provide? What can I rely on you before, during, and after, the investment, the sale? What what resources can you provide in terms of education, not just in terms of acquisitions and management, but what kind of educational resources can you help me with or provide? What kind of support staff do you have? Do you have transaction coordination? Do you have people who can respond in terms of inventory management, or a liaison between me and the management company or anybody else? Let me think. Can you help me analyze, the various deals? Can you help me break it down into the nitty gritty line by line? Can you help me verify the information? Because, like Ronald Reagan used to say, trust but verify. So, I can present you with information. We have tons of information on our website. 99% of the time it's accurate, all of it. But, there are typos, there are things that happen where there are mistakes. And so we automatically verify when someone tells us, hey, we want to buy that particular property. Great, no problem. So we send those numbers back to our boots on the ground, our team, our builder, our provider that we're working with, and have them double check and verify if those numbers are correct before we let the client go to contract. Same thing with you. You can do the same thing. You've been presented an information packet, an investor packet. Look at those numbers. Does it jive? Does it flow? Does it make sense? Confirm that stuff. Yeah. So those are some of the questions. There are probably many others. I'm just not thinking of all of them, but some of them will come organically in conversation.
Yeah, no, those are some really good tips. So, Marco, if somebody's looking to reach out and learn more about what you and your company does, where can they find you?
Yeah, we have two websites. Both are being rebuilt right now, so we're excited for the next 2 months when we'll launch the new and improved. Our property website is Norada Real Estate, Norada, noradarealestate.com. And then the sister website is also the home of our podcast, and that's passiverealestateinvesting.com. Just simply passiverealestateinvesting.com. A good domain name.
Oh, that's great. Well, Marco, it was a blast having you back on a second time, and thanks a lot for sharing those 10 tips with us.
It's been super fun, Seth. Thanks for having me back on. It's great.
It was my pleasure. And to you, our viewers, I wish you well on your journey from purchase to profits. See you next time.